I'm in now. Hello, everybody. How are you? Can you hear me?
Yeah.
I apologize. Apparently, I went into the wrong, I don't know what's wrong with me. Went into the wrong meeting somehow. I've been sitting there waiting for you guys. I'm so sorry. Let's get going here. We got Kate, Callie, and Kalai. Is that the name?
Yeah.
Hey, does anybody want to show their faces so I know to whom I'm speaking?
I don't have a camera on my computer. I got a desktop,
Hi,
not a
Kate.
laptop.
Well, how do I know it's you?
That's a good question.
That's okay. Don't worry about it. Hi, Callie. How you doing?
Good.
Again, I apologize. Cornelia just had to contact me and get me going. I'm okay now, Cornelia. Hopefully, huh? Hey, we got plenty of time here. What can I do for you? Would you like to go over PowerPoints again? Homework, exercises, questions? Anything in particular? Kate, maybe you could start.
I just started on the exercises after going through the chapter, so seems to be going okay, but I'm sure I'm gonna get stuck at some point. I don't have any specific questions right now.
Okay, how about you, Callie? Anything you're looking at that you'd like me to address?
Can you explain additional paid-in capital?
I sure can. Additional paid-in capital is as follows. When a company issues stock to the public, it goes out at a par value, say $1 a share, okay? That par value has nothing to do with what they're going to get for the stock. For example, a company like Facebook, they issued 1 million shares at $1 par value. What they really received for that stock was, say, $30 a share, okay? So your journal entry would be, you would debit cash for 30 million, and you would credit the account called common stock just for the par value, okay? The common stock line on your balance sheet is always going to be a multiple of the par value. So you have 30 million in cash, 1 million in the common stock. The difference is called additional paid-in capital. It is another equity account. When you issue stock to the public, you're always going to have probably that 3-line journal entry.
Okay.
Make a little bit of sense, Callie? Not yet, right?
Yeah, I hope you can show me the some calculator.
Absolutely. Let me see what I can get up here for us. Okay, hold on. I'll try to share something. Okay, nothing like an Excel sheet, right?
Yeah.
Here we go. I'll write a little quick thing up here, okay? Facebook issues, we'll say 10,000 shares of $1 per share common stock for $30 per share. Okay, so that's kind of what you would see in your problem. Okay, how do we record this? Okay, well, let's talk our debits and credits. We're up to debits and credits now, right? Debit, credit. Okay, 10,000 shares times $30, I believe, is $3 million. Would you agree? I think that's the right calculation. That's how much cash they received. The par value has nothing to do with what the public will price the stock at. So we're going to debit this for 10,000 shares. I'm just going to do it in math so I get my formula correct. 300,000, I guess it is, huh? Okay. So they received cash. We're going to credit 2 equity accounts now. We're going to credit common stock. And that is always going to be the multiple of the par value, which in this case is $1.
Mm-hmm.
Any difference between these two numbers is called additional paid-in capital.
So that $1 per share is the par
The one-
value.
Absolutely right. The $1 per share is the par value. This is called added paid-in capital. When I was in school, they called it paid-in capital in excess of par. It could be called excess.
I actually have the same question, or was thinking the same kind of question, is why are they getting that share at $1 instead of at $30 if that is the current price of the stock?
That's a good question, okay. First of all, the par value of the stock has nothing at all to do with the market value of the stock, nothing. It is a nominal required number in many states under many circumstances. Par value means nothing. It's just a legal requirement. In fact, some states, some situations, you don't even have to have any par value on the stock.
Okay.
But in our book, we'll always have par value, okay? It's just a legal requirement. It can be a penny, it can be $1, it could be $100, okay? Now, the reason, why do you think they got $30 a share instead of $1? Because before a company issues stock, they put out a prospectus. They don't just announce today they're issuing stock. They give the investing world time to review the company's prospects. So Facebook says, well, we're going to issue 1 million shares of stock for $1, and here's our financial statements, and here's what we think the future looks like. So that stock price that they receive from the public is what the public values it at. They're willing to pay $30 a share. That's where that number comes from. Now, if they only got a dollar a share for it, that would be be a kind of a disaster. It would be embarrassing. If they got 50 cents a share, that would be negative paid-in capital, I guess. But you get the idea?
Yes. Okay. Now I understand. So
You see that make a little sense then?
Mm-hmm.
Callie, what do you think? Okay.
Yeah, I got it.
Yeah. That's kind of important. What kind of accounts are these? Cash is an asset, right? What kind of account are these two?
Stockholder equity.
Yes, they're both equity accounts, huh? And the common stock will always be the shares outstanding or the shares issued times the par value, and you'll have that difference there. When we get into chapter 10, I think it is, on issuing stock and paying dividends, there's a whole bunch on this. I'm a little surprised this came up already. What else you got? Anything? How about you, Kalai? Anything you want to talk about? Are you out there, Kalai? Who else do we have?
I'm just listening. I'm just listening.
Okay, that's fine. That's fine. Hey, we listen. Hold on one second here. We've got one, two. Oh, okay. Cornelia and I are the two other participants. Okay. Kate, you want me to go through some homework questions or anything, exercises, or?
I've just started on the exercise.
In what chapter?
Chapter 2.
Okay. Give me an example of what they're asking you. Just pick anything at random you have there.
Sure.
See if I know it.
Okay, so I am on question 2 in the exercise for chapter 2. It says, Johnson, a company, received an investment of cash by organizers and distributed them 1,000 shares. Okay, so we just went through that. Okay, so that makes sense.
Okay. And
it's really just organizing the journal entry, which I totally get. So
right,
I don't have a question about that.
Okay, and some of these journal entries are set in stone. You have anything from your exercises you want to ask, Callie, or anything?
No.
What can I do to help you now? Go through PowerPoint or show you a problem, or? We're here to help. We can always do this, right? Oh, geez, go through a corner here. Anyway, I use that to torture the students once in a while, so be warned. Okay, are you good with your debits and credits? Okay, Kalai, you go first. Are you ready?
Yeah, as I'll ever be.
All right, ready. Cash, what kind of an account is that? Your choices are asset, liability, capital,
Asset.
revenue, expense. Cash.
Asset
What is accounts payable?
is accounts payable. Is liability, right?
Yeah, you got to get to the point where you're just zipping through these. Okay. What is sales?
Me again.
Yeah.
Revenue.
Okay. How about you, Callie? What's rent? We're paying rent. What is that?
What's that?
Rent.
Rent. Liability?
Well, it could be, but we're talking, yes, if it's an expense. Rent is an expense. What would be the liability is when we record it. We're going to debit rent expense and credit accounts payable. So you got that partially right. What about notes receivable? What kind of an account is that?
Asset.
Right. Here, Callie, you ready for a tough one? We're moving up the scale with a tougher question. You ready? What's the difference between accounts receivable and notes receivable? Or do you want to phone a friend?
I think they are all assets.
They're not quite the same thing, okay? Kate, you want to try to answer that one?
So accounts receivable is money from revenues that you've already earned, whereas notes receivable is money that you've lent.
Yeah, pretty good. Exactly right. Yeah, Callie. Kate said that pretty right. Accounts receivable are monies owed to you by your customers. The only way you increase that asset, accounts receivable, is when you sell something on credit. Okay? Notes receivable means that you loaned money to somebody. Notes receivable is a borrowing situation. Somebody borrowed money from us. Same thing with accounts payable and notes payable. Notes payable simply means we borrowed money from the bank or somebody. We borrowed money on a note for 3 years. We borrowed $1,000 and we're going to pay it back in 3 years. That is a liability. Notes payable. Accounts payable represents the money we owe to our suppliers and our normal business contacts, okay? All right.
Maybe sell something.
Pardon me?
Maybe sell something.
Not too tough, huh? Did you get into prepaids yet? We haven't talked about prepaid accounts, right? You don't know that yet, right? Okay.
No.
I won't go there. What else what do we got here, huh?
Actually, when you're talking about prepaids, I was curious about how that makes it an asset. Like if you prepay rent, why is that considered an asset if it's something you've spent money?
Good question. Good to get into now, as you will learn to an absolute empirical certainty. My favorite example is insurance, okay? Let's work with insurance. On December 31st, 2019, Kate and Callie and Kalai, you bought an insurance policy that covers you in the year 2020, okay? You paid $12,000 for an insurance policy that insures you in 2020. If your business, God forbid, burned down on New Year's Eve, you don't have insurance, okay? So that insurance that you own at the end of the year is an asset. It has value. We can only turn it into an expense when we get the benefit of the insurance. So we have a $12,000 policy. At the end of January, we're going to recognize $1,000 of that expense by debiting insurance expense, and we're going to credit the asset for $1,000. Now we have $11,000 in, and we're going to do the same thing in February and for the remaining months. The expense, any expense occurs when you actually, let me say it a better way, any expense is recorded when you actually incur it. We had insurance for the month of January, right? And you could say that cost us $1,000. At the end of the year, that prepaid asset of $12,000 will go down to zero.
Oh, yeah.
But wouldn't it only be an asset if you were to make a claim?
No, it has nothing to do with the claim.
Money?
Has that, no,
I
has
thought
nothing.
assets were assets that you can claim in the event of, you know, you have to liquidate the company at any given point. Those are the assets, but you wouldn't
Yeah.
necessarily get the money back for an insurance policy. So I'm just curious how
No,
that
the only,
makes.
no, when the expense only covers the period that the insurance policy covers, which makes
Okay.
sense, I would think, right?
Yes.
You prepaid. Prepaid rent could be the same thing. You know, when I moved into this apartment 21 years ago, they didn't trust me. I was out of town. I had to pay like 4 months in advance. I'm sure when they got that money, they, you know, they debited it, and they, you know, that became their, you know, prepaid rent, or in their case, unearned revenue. Okay. Callie, you have a question?
Not, no.
All right, here we go. You ready? We'll start. Oh, we have a new person here. Hi, on the bottom. Who's that?
Is it me?
Fiona, welcome. So
Yeah.
sorry I was late. My boss really justifiably got on top of me. She says, "You're in the wrong meeting. What's wrong with you?"
No
What
worries.
happened was I set these meetings up on my own screen, and Cornelia, of course, put them in the canvas where we need to access them. So now I'm a little smarter. Okay, we were just going over a couple things, Fiona. How long have you been there? You just got in?
Yeah, I just got it.
Okay, we were talking about cash. Let's go into something else, if I may. When you're doing the month-end financial statements, and you've tried to do those, right, in your exercises already, what statement must be done first and why? We'll start with the first part. What financial statement must be prepared first? You have no choice.
Income statement.
I hear income statement, which is correct. That is correct. And why is the income statement done first?
To get net income?
Yeah. You have to get the net income before you can do the second statement. You can't do the second statement until we get the income statement. What is that second statement? Anybody want to throw that name out if they remember?
Stockholders' equity statement.
Stockholders' equity. And in a moment, I'll put this on the screen here, okay? Stockholders' equity. We have to get the net income in order to do the stockholders' equity statement. And only then can we do the balance sheet. And let me, if I may, let me put this up here real quick, okay? We have an income statement. Our sales were 100,000. And bear with me. Does anybody here ever watch The Big Bang Theory on television? Anybody?
Mhm.
I'm like Sheldon Cooper. I have to do this, or I feel I'm out of sorts. I need this currency look. Sheldon Cooper. Here we go. Whoop, we don't want 4 decimals. What the heck is this thing doing? Look at this. The arrow up reduces it. Do it this way. Come on, one damn thing. Oh, I said a bad word. Okay, $100,000 with 1 decimal. Okay, sales $100,000. Expenses were 60,000. Okay. Expenses, 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 60,000, we'll say. Okay. So our profit for the year is $40,000, right? We have net income. Net income. Can you all read that clearly?
Yep.
Well, I can't. There we go. That's a little better. Okay, come on now. Okay, net income. Net income with an E at the end. Let's do that right. Net income. All right. We're done with the income statement. That's a super easy one. Now we have to do the stockholders' equity statement, okay? The formula for that, we start at the beginning, right? When I say we start at the beginning, we want to put down first the beginning equity, right? And we'll just make up a number. The beginning equity was $200,000. This was the equity as of January 1st. Maybe let's make it a little clearer. The beginning equity as of December 31. That's the start of your equity statement. Not too tough so far, huh? What do we add to it? Why did we do the income statement first?
We add retained earnings.
We add the net income eventually to the retained earnings. You're exactly right. And that's what we're getting ready to present here. Our net income was 40 G's, right? So net income increases your beginning equity. This company had a net worth on paper of $200,000 at the end of 2018, and now it's up to 240. Now your book talks about dividends a little bit, I believe already. Okay, you've seen dividends come up in the exercises. I think you did, and I'm going to assume that if the company was nice enough to give out dividends, that reduces your stockholders' equity. Say they gave out $10,000 in dividends. So that would give us a total of, I guess, 230, if I can do that right on my head here. Okay. Here is your ending equity. We'll say as of December 31, 2019. Okay. Make a little bit of sense, Fiona?
Yep. I just have one question about dividends.
Go for it.
Is it because I've seen a lot in like the exercises in the book, a lot of the companies don't give out dividends. Is that common actually?
Yeah, sure is. A lot of people don't want dividends. They get a dividend check, they get mad. You know why? The big companies that don't give out dividends tend to be the tech companies, the up and comers, like Apple used to be. And the reason for that, Fiona, is that company is telling the world we need to plow every single dollar we can get our hands on into research.
Okay.
With the hope of really coming up with a successful product.
Okay.
And only then we'll start issuing dividends. In the meantime, the people who hold those stocks are looking at the price of the stock.
Okay.
If you bought Apple, I just finished reading a big giant biography of Steve Jobs. If you bought Apple stock about 10 years ago, when he returned it was selling at $5 a share.
Oh wow.
And there was no hope of getting a dividend. They didn't even have the cash to do it. But if you held on to that stock today, that stock is worth now about $1,000 a share. Okay? And what they did during that time, they paid no dividends, and they came up with a pretty good product called the iPhone, right? And now they can pay dividends like crazy. I don't know if they do or not, to be honest with you. I don't follow Apple. But that's what's going on there. Companies do not all pay them, nor do they have to pay them, okay? May I add one more line to this? What else might increase this? Let's say we have 25,000. What also might increase this? Contributed capital. Contributed capital. What do I mean by that? Anybody have understanding what that might be? Nobody, huh? Contributed capital. This means that the owner of the business put his own money in. The owner of this company either put money into the company or he issued more stock. That's called contributed capital. Common stock and the paid-in capital, that's contributed capital. Make sense, Kalai?
Yeah.
We're keeping you awake since we can't
No,
see
no,
you.
no. Yeah, yeah. I'm sorry. I'm writing all this down.
So here's our simple income statement here, right? Simple income statement. Here, oops, let me get rid of that. I'm sorry. Wanted to stop here. Our simple income statement, nice yellow. Here is our equity. Uh-oh, I might have to go back to the table. Okay, give me a second to plug in, guys, okay? Hold on. You may lose my face. Right. Come here, you. Let me plug in. There you go. Okay. What I'm trying to tell us here is that this equity statement, it flows from the income statement. You see this $40,000 here? That income is what you need to complete this statement. You can't do this statement without the equity, right? Anybody confused by that?
Is contributed capital just another word for asset?
No, 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 no. Capital is not an asset. Capital means stockholders' equity. Equity.
Oh, okay.
Equity. Yeah. And now if you had a balance sheet, I'm just going to make up some numbers here. Let's say we had cash. Got this thing in my
So
lap.
would that be something like a venture capital investment? Or like is that
Sure, good. Oh,
is that what the
absolutely.
difference? Okay.
Oh, absolutely, it could be contributed capital. Yeah, somebody has an idea for a new product, but they don't have any money. Absolutely, they could go to somebody, and try to attract what's called a venture capitalist or an angel. Have you ever heard of an angel investor? An angel investor, I mean, a guy just gives you money. And normally, what they do when they do that is they demand a piece of the company, right? So now you have a what's this thing doing to me here? So when you do your balance sheet now, you're going to have cash. And excuse me, this thing is giving me a hard time. I got happy fingers. Cash. And we'll just say AR. And you might have AP. AP. Accounts payable. And cash was 10,000, whatever, 100,000. This was 400,000. So this would be 500,000. There's your total assets. Total assets. Yike, that's not even close. Huh? Total assets. You know that means total, right? The heck? I swear, I do know how to spell the word total. What the heck is this thing doing to me? Cancel, cancel, cancel. Well, we're going to sit here until I get the word total in there, believe me. There we go. Okay, total assets. We have AP, accounts payable. Maybe we have notes payable. And this was 200. And this was 200. All you would do now is copy the new equity over, 255, right? 255. And these would have to balance. I'm going to balance them out in a second. Here's your equity. $425.5 minus this, so we'll put another asset in here. We'll call it notes receivable, just to balance. Notes receivable. Doing it the hard way, I guess. Well, if there's God in heaven, these two should add up, right? Ah. Anyway, darn it. What we're saying here is you bring the equity over to your balance sheet, okay? 425, I just need to change this to equal. This is what, 400, we'll make this 10,000. This is called cheating, just to get it to work out. That's 425, right? Yeah. 425, come on now. Wow, I tell you, when this thing is in my lap here, it's terrible. Okay. My point that I'm laboriously making is this 255 is what you bring over to your balance sheet and you will then balance. Would you like to see it from the book a little more clearly? I could do that if you like. I found the other day when I was doing the class, I finally found the better slide. Keep hitting the wrong button here, huh? Slideshow. There we go. Let's see what we got here. Hold on. Give me a second here. We'll get the right one here. I know you can't see the screen yet. Well, let me share. Can you all see this? Can you see the slideshow now?
Yep.
Yep.
Okay. Okay, let's see here. The balance sheet. It's just a presentation of the accounting equation. Your total assets must equal liabilities and equity. Balance sheet is simply sales minus expenses, and the statement of retained earnings is sort of the bridge between the two. The reason you run a business is to increase the business's value, and you do that by making money, making a profit. So first you got to find out what your profit is, and then you're going to put down where you're now going to put it down and add it to what the prior worth was. And then you can do your balance sheet, the equation, the balance sheet. Here's a look at a balance sheet. Get this out of the way. You can't see this, I don't think, but this thing is bugging me. The balance sheet. Assets equal liabilities plus equity. And we can't even begin to do this. At the end of the month, in a couple chapters, we're going to get into the closing process where you're going to put together a 10-column worksheet. And at the end, and in those last two columns will be the correct balances for every single account except one. And that's going to be the equity. My point being, when you go to do the balance sheet, you only have to figure out one number. Otherwise, you're just copying. This thing
I have
suddenly
a
got,
question about the balance sheet.
yeah.
In the book in chapter 2, it says that some companies have like a lot of off balance sheet financing, and they said that it's a lot of rent. But why wouldn't that be included in the
It says off balance, off, say it again, off what?
it says off balance sheet financing.
I
says
am going to have, I don't
not
know what the,
reported as studies.
you read that in the book in chapter 2?
Yeah.
To be honest with you, I'm going to have to go back and look, because when I hear the words off balance sheet, that brings up notions of fraud. That's what Enron was doing. Are you familiar with Enron, any of you?
Yeah.
Yeah, Enron was the greatest financial fraud. And they had all these things called off balance sheet and all these crazy things. And you know how they got caught in their fraud? There was a young financial writer for Fortune magazine named Bethany McLean, and she was a CPA, late 20s, 30s. She knew her stuff, and she went to Enron and spent a couple of days with the crooked chief financial officer, a bum from my area, New Jersey, Andy Fastow. And after 2 days, she still didn't know what they were doing. She never suspected fraud, though. She wrote an article that was entitled, "How Does Enron Make Its Money?" And that was the end of Enron, because no one could figure it out. It was all this off balance sheet. So before I even answer that, I'm going to go look at the book and see what they're talking about. Okay. Anyway, when you're finally done with this course, I know you have no time now. So many wonderful movies about Enron. The president of Enron, I'm going to be very nasty here, and you have to forgive me, Ken Lay, he was selling his stock at the same time he was telling his own employees to keep buying it. He had the good courtesy to die in prison before they could put him away for too long. And the mastermind is still in jail 17, 18 years later. Income statement, revenues minus expenses. Question, what is cost of goods sold? Anybody?
It's the cost of the inventory you used for the sales.
Exactly right. You said that perfectly. It's the cost of the inventory you sold. Cost of goods sold is what you paid for the merchandise. You sold me a men's suit today for $500, and I paid you $500. That's your revenue. It cost you $200 to buy the suit. That's your cost of goods sold. You have what's called a gross profit at that point. Here is your income statement, a simplified form here. You notice that the words net income come after you put the tax, you record the taxes. This is called operating income. Operating income, your revenue minus your operating expenses is called operating income. Investors will be looking at this number, the operating income, okay? And look at this simple little formula here, huh? This is your simple template for doing the equity statement. They're calling it statement of retained earnings because they're just looking at retained earnings. But you could change retained earnings to, stockholders' equity, which is the master. You okay with that, Callie?
Yes.
You have a beginning equity balance of so much plus income minus dividends, huh? There's your statement of retained earnings. Start off with 6,805. Net income, 3,300. Dividends, they were nice enough to give out $1,000 in dividends. Their retained earnings. Now, we're assuming in this company they never issued stock or anything. Everything's in retained earnings. Okay. Where do we get to the chapter on cash flows? You're going to have fun with this. What did I say? The only thing we're interested, what are operating activities? Anybody want to tackle that one? I think Callie knows that one, right, Callie? What are operating cash flows? Operating cash flows.
Sell something good to customer and receive cash.
Yeah, you're on the right track when you use the word customer. Operating cash flows are those cash flows that occur in the normal business activity. In other words, Coca-Cola, what is their business? Their business is making and selling soda, right? They sell potato chips. They sell orange juice. They sell snacks. So when they're buying their raw materials, that's operating. When they're selling that product, it's operating. Paying the employees, operating. There are two other kinds of cash flows that have nothing to do with running the business, and that is investing. And there's two categories we'll go through in this book. When a company buys a big piece of equipment that's going to last for a number of years, that's considered an investing cash flow. If they buy stock in another company, investing cash flow. So those would be negative cash flows, right? Because they're spending money. Now, when that investment they bought starts paying dividends, that would be investment inflow. The third one is financing. And a simple word for financing is borrowing. Financing. You either borrowed money from a bank or some rich person, or you raised money through a stock issue. So I think all you need to do is the three different types of cash flow. Are you there, Cornelia? Probably not. I think she's there just to keep me in line here.
Wait, sorry,
But-
I missed the last one. Operating, investing, and
Financing, which is borrowing.
yeah, borrowing. Okay, that makes
So you either borrowed money or you issued stock to the public. Or you went to your mother. Can you please give me, you know what I mean? Put whatever, however you put the money in, okay? And here's our beautiful flow of the statements. I should have gone to this before I fooled around in Excel. Net income was 3,300. We know we have a beginning equity of 68. We know we gave out dividends of 1, but we also have to add into that the net income. The net income. Okay? You okay with that, Fiona? This is the one where the students tend to get a little rattled. It's your beginning balance plus any contributed capital plus net income minus dividends, huh? So this company earned a profit of about 10%, huh? That's pretty good, 10%. And their equity went up by about 30%. Went from 7 to 9. It went up about 1/3, say. So they had a pretty good period. And now that we've got the statement of retained earnings done, we can shove this guy into the balance sheet. Okay? Think you can do the statements now from your problems? As long as you do as long as you do them in the right order, you'll help yourself greatly. I remember working in the accounting field, and some of the people working for me, young people, no offense, they come up and say, "Hey, Bob, I see you're working on the income statement. How about I do the balance sheet to save time?" Well, yeah, you can do it up to a point, but you can't really finish it until I'm done. And cash flows. Let me just show you what the cash flows means, okay? You see this company had $1 million in operating cash flows, which is a positive number. That's cash in. They also made money from financing. They borrowed $400,000, but look at this. They went out and bought a big machine, maybe for $1,625. So cash went down $156. And all that means is that cash at the beginning of the period was this amount minus the ending. That's all we're talking about. I don't want to spend any real time there to confuse you. Has anybody come up with any questions on notes to the financial statements at all? Notes to the financial statement. When you start doing your project, the FSAs, and you've all looked in American Eagle, right? And the other company?
Yeah.
A lot of notes there. Did you notice that, Kalai?
Yeah, that was tough, but nah, it makes sense. I had to like read it.
Yeah, notes. For example, you see cash on a company's 10K on their annual report. Eventually, you're going to see the balance sheet with the number 1 here. It'll say note number 1, and then they'll explain what the cash is. Well, you and I kind of know what cash is, but they're going to say we have so much in short-term certificates of deposit. We have so much in this. We have so much in this. They'll explain it in detail. They'll have their liabilities. They'll explain the liabilities in detail. Our customers owe us this. We normally collect from them in a certain amount of days. The notes are very, very important when you get into the FSA. And did anybody give you the companies yet you're going to do with the FSA? You've not heard anything, right? I'm going to triple check with Cornelia. I'm going to give you my 2 favorites to compare, Coca-Cola and Pepsi-Cola, when the time comes, okay? So you should get that communication later today. I tell you, if Cornelia's listening in, I know she's going to kill me when we get done here. You ready? What else we got? All financial statements with notes, lots of notes. And who uses the financial statements? Guess what? The people who run the business need to use the financial statements, the marketing people, credit managers, the bosses, manufacturing, right? You know, the salespeople, they look at the financial statements and they look at the notes and they see that a particular product is selling much better than another. Some products are not selling well. They need to do some analysis to see whether that's good or not. Purchasing managers use the statements, decide the supplies are good. Guess what? Human resources use the financial statements. You go into your boss for a raise, you go to the human resources manager, and you say, I would like a raise of 10%. And they'll say, well, I was just looking at the income statement and we can't afford it, okay? My old girlfriend, where I used to work a long time ago, was the boss of human resources and was a pain in the neck at the job. My definition of human resources is that's the department that prevents you from getting the people you need to succeed. That's just me now, but I wouldn't repeat that, okay? That's why we don't see each other anymore. And look at this grid. You notice this is a different presentation than the other day. You know, have this in front of you while you're doing your problems. Balance sheet, it's the financial position. It's basically the accounting equation. They're giving you the stuff that's on there. Income statement tells you if you made money. Sales minus all your expenses. Statement of retained earnings. There's that little template again, beginning and cash flows, which we're not going to worry about. Would you believe we have a whole chapter just on doing the cash flow statement? I don't lie. End of part, whatever that was for chapter 1. What else can I do for you? Is there anything you wanted me to look at today? I got all kinds of stuff available. Any other questions, Callie? You have any trouble with the exercises?
No.
You can do them perfectly now?
Mm.
I'm just kidding, Callie. I know it's not an easy class. Anything from you, Kate? Anything you'd like me to?
No, I think I was definitely stumped at the debit and credit, but it totally clicked. So
Debits and credits are starting to click now?
yeah, it's totally going for me now. So
Okay. We're gonna
I'm good. I'm good.
all right, we're gonna test everybody real quick on that. By the way, are you related to my old friend from New Jersey, Ted Kubiak? No?
No, I don't think so.
Or the football coach Gary Kubiak?
Nope.
No, right?
No relation.
We had a lot of Kubiaks where I grew up. All right, you ready? I'm going to test you guys. I'm going to start with Fiona. The question is, the answer is either debit or credit. You ready?
Yeah.
Rent expense, debit or credit?
Credit.
Nope, so you're just guessing. This is the hard part right now. Assets. Before, let me get this one right. After eating, let's read comics. Can you remember that? After eating, let's read comics. Assets, expenses have a debit balance. After eating, let's read comics. Liabilities, revenues, and capital. You don't have to use those kinds of things. All right, Kate, let's just, Kate says, notes payable.
Notes payable are credits under liabilities.
Right, credit, notes receivable.
Are debits under assets.
Cash, Kelly, debit or credit? Kelly has to think.
Yeah. Asset, debit.
Debit, yeah. Yeah, we got to get to the point where you know it like your own name. This to me is one of the hardest parts of the entire course. But it's probably the most important, because if you're not real comfortable with the debits and credits going forward, you're always going to have to hesitate. And it'll cause difficulty in analyzing. You want to try a few more, Fiona?
Sure.
Inventory, debit or credit?
It's an asset and it's debit.
There you go. Asset is a debit. Common stock.
That's a credit and it's stockholders' equity.
Equity, yeah. Yeah, you got it. You got it. What else can I ask here? Okay, let's see if we can do 5 in a row real quick. Kalai, you ready to start?
Sure. I'm ready as I'll ever be.
All right. Not rent expense,
Yeah.
but telephone expense, debit or credit?
That's credit. But I don't know. So expense credit?
Yes. Yeah, I'm kind of chuckling because believe me, there's 40 people in our class and the other 36 are going through the same thing. Nope. All expenses are debits. After eating, right? Assets, expenses. Here's a tough one now. You ready, Kalai?
Yeah,
Salaries
I'm ready.
expense, debit or credit?
That's credit and no?
Listen to the acronym. After eating, let's read comics. A stands for assets, E stands for expenses, and those are your debits. Assets and expenses are debits. Liabilities, capital, and revenue
For
are
credit?
question?
No. Okay.
You
Wait,
want to
so
try? Go ahead.
Wait, you said salary expense?
Right.
Okay. I just don't understand. So, okay. I get it. I just got to read about that.
Right. Salaries expense is a debit. What about salaries payable, Kate?
Can you repeat that?
Salaries payable, debit or credit? So you still have to look a little bit, huh? I'll give you some, it's a liability. When you hear the words payable, that means liability automatically. Credit. Expense automatically is a debit. Callie, what about paid in capital? What about additional paid in capital, Callie? Is that a debit or a credit? What part of it is that?
Credit.
Pardon me?
Credit.
Credit. What part of, what is it? Asset, liability, equity, revenue, expense?
Mm,
It's part of your capital, right? Your capital, equity. Capital and equity are the same thing.
oh, capital.
And your equity, your equity has different parts of it. It has retained earnings. It has. All right, Fiona, what about notes receivable? Debit or
That's
credit? How come?
that's a debit and it's an asset.
Yeah, no, that's good. What about inventory?
That's also a debit and it's an asset.
Yeah. How about insurance expense?
That's it's an expense
Yes.
and it's a credit.
No, it's a debit.
Oh, it's a debit.
Anyway, you get the idea. You just have to keep punching away at these. I mean, there's all kinds of acronyms. You can go on the internet, you'll find people singing songs. I've broken out the guitar and done stuff, but
What was the last one? An expense? What was the last question?
I think it was insurance expense, I said, right?
Why is it a debit?
It's an expense.
Expense.
Why is
Every
it?
expense is a debit.
Every expense is
Okay.
a debit.
I can
Every
get with
expense is a
that.
debit. Okay.
Yeah, with that.
Every expense is a debit. Right, hold on, let me, if I may, let me just do one other thing here. When I was 15 minutes late, Kate, did other people leave? Have I thrown anybody out of here by mistake?
I don't know because we weren't able to get into this meeting without
Oh, so
you
you-
here.
I
So
was.
I
was
don't
in the-
know.
Yeah.
I don't know who else was waiting to get in.
What a stupid question. That was the whole point. Nobody can get into the meeting. Oh, I'm in big trouble. Hold on, I want to get this other thing real quick. Come on now. Share this if I may. Can you see the chapter 2 here now?
Yeah.
Okay. This is where you start getting into the debits and credits. And I'm just going to come along here. Your balance sheet. Here's one way you might remember. Balance sheet. If assets have a debit balance on this side, everything on this side has a credit balances. One way to look at it, huh? Liabilities, credit, equity, credit. Well, these guys are debits. I'm looking for when they first get into debits and credits, huh? See, earlier, some of the problems you're doing now, correct me if I'm wrong, they're starting you off without debits and credits. Is that correct, Kate? In other words, on this problem here, they're saying identify and classify. They're just doing pluses and minuses to begin with, I believe.
Hmm.
They're just trying to get you the idea, you know, when somebody borrows money from the bank, guess what? Your cash goes up 6,000. Well, you know that intuitively, right? And intuitively, you know you owe the money, so the liability goes up. But intuitively, we got to be able to do it via the debits and credits. And that's kind of what I'm looking at here. Debits and credits. This thing is repeating itself. Good heavens, look at this thing. No, it didn't quite have what I wanted, but we can live with that. Anything else, anybody? And you know, anything I can do for you? Callie, you good?
Yeah, you mean every expense or debit? So how about revenue?
Say that again, please.
How about revenue?
Revenue is a credit balance.
Mm.
Revenues have credit balances. The opposite of expenses, right?
Mm-hmm. Yes.
What does debit and credit mean, Callie? Simply.
Debit is the account left.
Did you say left?
Yeah.
Yeah, exactly. All it means is left and right. That's all it means.
Credit right.
That's all it means, okay? It doesn't mean up or down. It doesn't mean good or bad. It means left and right. If
Okay.
cash is debited, that's probably a good thing, right?
Mhm.
If it's credited, it goes down. Maybe that's a bit, but anyway, you get the idea, okay?
Yeah.
I don't know if I want to show you guys this meeting because I was in the other meeting. This meeting, I should be okay. When I didn't see anybody for like 10 minutes in the other meeting, I picked up the guitar and I was singing and telling jokes and all kinds of stuff. But I think we're okay here. You ready to cut it off now, or you got anything else for me? All right, well, enjoy the rest of the weekend, okay? And I apologize for being late. And now I'm still assuming that Cornelia's there. I'll call her now and try to make up an excuse why I went into the wrong meeting, okay?
All good.
All
Thank you
right.
so much. This was really helpful. Thank you.
I hope so. And
All
there's
right.
more, and you know you can always text me, and you've got my own email now, right? I
Yeah.
gave that
Thank
up.
you.
Okay, goodbye everybody.
Bye
Good
bye.
night.
See you in church.